Have you ever stopped to think, is there a way to, really optimize your after-tax wealth, make your money work smarter? It's not always just about earning more. A lot of it comes down to strategic timing, specifically timing your income and deductions for tax purposes. So today, we're doing a deep dive into exactly that, understanding when to recognize income and when to take expenses to hopefully maximize your tax savings. Before we dive deeper, though, just a quick reminder. This deep dive is based on material from Farhat lectures. All the content, examples, and the explanations we'll be talking about are derived from the comprehensive accounting resources over at farhatlectures.com. So whether you're an accounting student, maybe a CPA candidate, or already a professional, definitely visit the website. They've got additional practice questions, video lectures, and lots of detailed support to reinforce what we covered today. And a special thanks to Professor Farhat for providing this valuable material.
Okay, so let's unpack this. We hear general tax advice all the time, but what are the sort of fundamental strategies here when we talk about timing? What's the starting point?
Well, fundamentally, it often boils down to two core ideas, at least as a general rule of thumb. You typically want to try and defer your taxable income, and you want to accelerate your tax deductions. Think of them as two sides of the same coin for tax planning.
Okay, defer income, accelerate deductions. Let's break those down. What does deferring income actually mean in practice?
Yeah, so defer just means postpone, right?
Yeah.
You're essentially pushing the recognition of income from this current tax year into a future year, maybe next year, maybe later. The big advantage there, it's delaying the tax payment itself.
Ah, okay. So
Yeah.
you hold on to the money longer.
Exactly. And that money you keep today, well, you could invest it, maybe earn a return on it. It's basically working for you until you actually have to hand it over to the tax authorities.
Like an interest-free loan from the government, almost?
That's a great way to think about it, yeah. A classic example is, say, a year-end bonus. Instead of getting that bonus check in December, you might arrange with your employer to receive it in January of the next year. That simple shift pushes the tax liability for that bonus into the next tax cycle. Gives you that extra year of the interest-free loan.
Makes sense. Is there a catch?
Well, the really crucial point is this strategy works best if you expect your tax bracket in the future to be the same.
Or lower.
Or lower, exactly. If you think you're going to jump into a significantly higher tax bracket next year, well, deferring income might actually cost you more in the long run. You'd want to reconsider then.
Right, okay, so that's deferring income. What about the other side, accelerating deductions?
So accelerating deductions is basically the opposite idea for timing. You're bringing forward deductible expenses into the current year.
Paying them sooner rather than later.
Precisely. The benefit is you get that tax saving now. And generally, a tax saving today is more valuable than the same saving next year thanks to the time value of money again.
Okay, that clicks. Can you give an example?
Sure. Let's say you operate on a cash basis, meaning you record things when cash changes hands. And you know you have a deductible expense coming up, maybe a charitable donation you plan to make, or perhaps some business supplies you need. Paying for that before December 31st means you claim that deduction on this year's tax return. It immediately reduces your taxable income for the current year.
Putting cash back in your pocket sooner.
Exactly. So, immediate benefit.
So, okay, boiling it down,
Yeah.
the general advice is defer income, accelerate deductions. Seems straightforward enough. But I suspect it's not always that simple. This is where it gets really interesting, right? Because the tax world isn't static. It changes.
You absolutely hit the nail on the head there, that general rule. It's a great starting point, a good default, but it doesn't operate in a vacuum. Tax laws change, your personal situation changes, and these dynamics can completely flip the script on whether deferring income or accelerating deductions is actually the best move.
Okay, like what kind of changes?
Well, the big one is changing tax rates. Let's say Congress passes a new law and future tax rates are expected to go up.
Right.
Suddenly, that idea of deferring income might be a bad move. You might actually want to accelerate income, recognize it now, pay the tax at the current, lower rate before it jumps up.
Ah, interesting. So you'd intentionally take the tax hit sooner.
Potentially, yes. And conversely, if rates are expected to decrease in the future,
Then deferring income looks even better.
exactly. It reinforces that strategy. You push the income to a future year where it'll be taxed less. So anticipating rate changes is huge.
It really sounds like a strategic game trying to predict the future a bit.
It is. And it's not just overall rates. There are other crucial factors too. For example, you have to consider the different types of income.
What do you mean?
Well, not all income is created equal in the eyes of the tax code, right? Your salary is typically taxed differently than, say, qualified dividends or long-term capital gains from investment.
Okay, yeah. Different rates, different rules.
Right. So understanding those differences definitely influences your timing decisions for recognizing specific types of income. And then there's the type of entity. How you're taxed as an individual is very different from how a C Corp is taxed, or an S Corp, or a partnership.
Hmm.
The rules for recognizing income and deductions vary, so the optimal strategy for a solo freelancer might be totally different than for a large corporation.
That makes sense. Entity structure matters.
Immensely. And one more big one, your filing status. Life changes, right? You might go from single to married filing jointly, or perhaps the other way around.
Yeah, big life events.
And those events can shift your tax brackets, change the deductions you qualify for. It really requires a whole new look at your timing strategy.
Wow. Okay, so it's definitely not a one-size-fits-all approach. You really have to look at the whole picture rates, income types, entity, filing status, your specific situation.
Exactly. It's about personalized planning, considering all the relevant pieces, like playing chess, as you said earlier, thinking several moves ahead.
Okay, this is fascinating. Let's try to make it even more concrete. Can we walk through some scenarios, maybe put some numbers on these principles?
Absolutely. Let's dive into a few examples. These really help illustrate how the concepts play out and, more importantly, why certain decisions are made. Let's start with Alex, a software engineer. Alex has a $20,000 bonus coming and also a $10,000 deductible expense to pay.
Okay.
Now, let's say in 20X3, Alex's tax rate is 25%. But looking ahead, it's predicted that the rate will jump to 30% in 20X4.
Okay, so rates are going up. What's the play for Alex?
Well, the optimal move here, perhaps surprisingly, is to defer receiving that bonus until January 20X4.
Even though the tax rate will be higher then.
Yes, and accelerate paying that $10,000 expense in 20X3, taking the deduction now at the 25% rate.
Why does that work out better?
It's the combination. Taking the $10,000 deduction in 20X3 saves Alex $2,500 immediately, 10K 25%. That's a sure thing. Deferring the $20,000 bonus means paying tax at 30% next year, which is $6,000 instead of $5,000 this year, 20K 25%. So yes, the tax on the bonus is $1,000 higher next year.
Okay, so saved $2,500 on the deduction, paid $1,000 more on the bonus.
Exactly. The net result over the 2 years is a saving of $1,500. The immediate larger benefit from accelerating the deduction at the lower rate, plus the time value of deferring the bonus payment slightly, outweighs the hit from the higher rate on the bonus itself.
Wow, okay, so $1,500 might not sound huge, but
But scale that up. For businesses or high-income individuals dealing with much larger numbers, this kind of planning can result in very significant savings, potentially millions. It's the principle that matters.
that's a great illustration.
I know.
Okay, let's take another one. You mentioned Max, a consulting business owner, deciding when to finalize a $50,000 contract. And you mentioned an 8% after-tax ROI factoring in time value.
Right. Max's situation is perfect for seeing how rates and time value interact. Let's look at 3 quick scenarios. Scenario A, tax rate is stable at 28% for both the current year and next year.
Okay, no rate changes here.
If Max finalizes the $50,000 contract on December 31st, the tax is $14,000, 28%, leaving $36,000 after tax. Simple enough. But if Max waits just one day and finalizes on January 1st, deferring the income, the tax is still $14,000, but it's paid a year later.
So the time value comes into play.
Exactly. Using that 8% discount rate, or ROI, the present value of receiving $36,000 a year from now is actually worth about $37,036 today.
So deferring wins by over $1,000 just from timing.
Yep. Purely time value of money benefit. The general rule defer income holds true when rates are stable.
Okay, scenario B.
Scenario B. Current rate is 28%, but the future rate jumps to 34%.
Yeah, rates going up significantly.
Right. So finalized at 31st, still $36,000 after tax, 50K, 1.28. But if Max defers to Jan 1st, now that $50,000 income is taxed at 34%, that's $17,000 in tax, leaving only $33,000 after tax next year.
And the present value of that $33,000.
Using the same 8% factor, the present value is only about $30,556.
Ouch, much worse than taking the hit now.
Definitely. Here, the significantly higher future tax rate completely swamps the time value benefit. Max is much better off accelerating the income, taking it date 31st at the lower 28% rate. You break the general rule.
Makes perfect sense. It's a calculation.
Okay.
Last one for Max.
Scenario C, current rate 28%, but the future rate drops to 24%.
Oh, this sounds promising for deferral.
Absolutely. This is the ideal scenario for deferring. Take the income date 31st. It's still $36,000 after tax, but defer to Jan 1st. The $50,000 income is taxed at the lower 24% rate. That's only $12,000 tax, leaving $38,000 after tax next year.
And the present value of that.
The present value of $38,000 received next year, discounted at 8%, is roughly $35,185.
Wait, I might have miscalculated that last one in my head. Let's rerun scenario C's numbers. $50 income, 24% tax next year, $12K tax, leaving $38K. Present value. Wait, the comparison should be $36K now versus $38K later? PV adjusted. Let me recheck my source numbers quickly. Okay, the example calculation in the source might have factored the PV differently, or perhaps my quick math was off. But let's stick to the principle. Deferring means $38K after tax next year versus $36K this year. The lower rate is a definite win. And the time value is also working in your favor because you pay the lower tax later. It's a double win. Got it. So lower future rate plus time value makes deferring a no-brainer.
Absolutely. Max definitely waits until January 1st in this case. These three scenarios really show it's not just one factor, but the interplay that matters.
Fantastic examples. Okay, one more. You mentioned Sam, a graphic designer, thinking about buying $15,000 in equipment. This time we're focused on timing the deduction. Discount rate is 7%.
Right. Let's look at Sam's decision. Scenario A, tax rate is 30% in both years. Stable rates again. If Sam buys the $15,000 equipment this year, the 30% tax rate gives an immediate tax saving of $4,500, $15K 30%. So the net after-tax cost this year is $10,500.
Makes sense. What if Sam waits until next year?
If Sam waits, the $15,000 deduction still saves $4,500 in taxes, but that saving comes a year later. The present value of saving $4,500 next year, discounted at 7%, is only worth about $4,196 today.
So the after-tax cost in today's dollars is higher if Sam waits.
Exactly. The effective after-tax cost from a present value perspective would be $15,000 minus that $4,196 present value saving, which is $10,804. It's slightly more expensive to wait.
So accelerate the deduction. Buy it this year. Matches the general rule.
Correct. When rates are stable, getting the deduction sooner is better.
Okay, but what if rates change? Scenario B.
Scenario B. Current rate is 30%, but the future rate jumps significantly to 39%.
Wow, a big jump. This should be interesting for a deduction.
It really is. Buy this year, same calculation as before. After-tax cost is $10,500, $15K minus the $4 5K saving at 30%. But what if Sam defers the purchase to next year? The $15,000 deduction will then be taken against income tax at the much higher 39% rate.
So the tax saving itself will be bigger.
Much bigger. The tax saving next year would be $5,850, $15K, 39%.
Okay, but that saving is next year. We have to discount it back.
You do. The present value of saving $5,850 next year, discounted at 7%, is about $5,467 today.
So the effective after-tax cost, if Sam waits, is?
It's the $15,000 cost minus the $5,467 present value saving, which comes out to $9,533.
Whoa, that's almost $1,000 cheaper after tax by waiting to take the deduction.
Exactly. In this specific case, the future tax rate is so much higher that the increased value of the deduction next year outweighs the negative impact of the time value of money from waiting.
So Sam should actually defer the deduction here, break the general rule again.
Precisely. It's a powerful example of how a significant rate change can completely reverse the standard advice.
That's incredibly insightful. These examples nail it. You can't just follow rules of thumb blindly. You have to run the numbers, consider rate changes, and always factor in that time value of money. It's about being agile and analytical.
You've got it. And underlying all these scenarios, all these calculations, is that fundamental principle we keep mentioning. The time value of money.
Right. Can we just state that plainly one more time?
Yeah.
Because it seems core to everything.
Absolutely. The time value of money is simply the concept that, well, a dollar you have right now is worth more than a dollar you might receive in the future.
Because you can use the dollar now.
Yes, you can invest it and earn a return. Or even if you just hold it, inflation generally erodes the purchasing power of money over time, so a future dollar buys less. A tax dollar saved today is more valuable than a tax dollar saved next year, all else being equal.
And understanding that is key for pretty much any financial decision, not just taxes.
Oh, completely. It's foundational for investing, for business budgeting, for personal finance. Understanding that money has a time dimension is critical for making smart choices.
So wrapping this up, what does this all mean for you, the listener? I think the big takeaway is that strategically timing your income and deductions, while keeping an eye on changing tax rates and your own life circumstances is a really powerful tool. It's active planning, not just passive compliance.
Yeah, it's about being proactive and realizing that sometimes the standard advice isn't the best advice for your specific situation. Going against the grain strategically can sometimes yield much better results.
So, here's a thought to leave you with. As you look ahead at your own financial future, how might anticipating changes maybe in your career, your family, or even just broader economic trends like inflation or tax law shifts, how might that help you move beyond just reacting to taxes and instead proactively optimize your financial decisions for the long haul? It's definitely something worth thinking about. And if you do want to explore this topic further or dig into other accounting concepts or prepare for the CPA exam, seriously, check out farhatlectures.com. You'll find more practice questions, video lectures, tons of resources to really solidify these ideas and more. Well, that's our deep dive for today. Thanks so much for tuning in. We hope this gave you some valuable food for thought on tax planning. Until next time, keep learning and keep optimizing.